Look, I need to show you something that's happening right now in the financial system. Something that most people won't see until it's too late. And by then, the opportunity to protect yourself will have already passed. You know what's interesting? When you look at what the world's most powerful institutions are actually doing with their money versus what they're telling you to do with yours, there's a massive disconnect. And that disconnect is about to cost a lot of people everything they've worked for. Let me paint you a picture. Right now, central banks around the world are buying gold at a pace we haven't seen in over 50 years. We're talking about institutions that control trillions of dollars, institutions that have access to information you and I will never see, and they're converting their reserves into physical gold at record levels. Through the first 3 quarters of this year alone, central bank gold purchases exceeded 1,560 tons. That's a 33% increase from the previous year. Think about that for a second. These are the same institutions that print money. They can create currency out of thin air with a keystroke. And yet, they're trading that currency for gold as fast as they possibly can. What do they know that you don't? Here's what makes this even more fascinating. This isn't just happening in 1 or 2 countries. This is a coordinated global movement. China's central bank has been adding to its gold reserves for months on end. Russia has been stockpiling gold for years. India, Turkey, Poland, Singapore. The list goes on and on. These countries don't agree on much, but they all agree on one thing. Get gold, get it now, and get as much as you can. And it's not just central banks. Total gold demand hit a record value of $132 billion in just 1 quarter. Investment demand through ETFs, futures, bars, and coins, combined with central bank purchases, totaled around 980 tons in a single quarter. That's over 50% higher than normal levels. This is panic buying disguised as prudent reserve management. Now, you might be thinking, okay, but what does this have to do with me? I'm not a central bank. And that's exactly the point. You're not a central bank, which means you don't have the luxury of being wrong. When a central bank makes a mistake, they just print more money. When you make a mistake with your life savings, you don't get a do-over. So, let me ask you something. Where is your money right now? If you're like most people, it's sitting in a bank account, earning maybe 1 or 2% interest, while inflation runs at 3, 4, 5% or higher depending on what you're actually buying. Or maybe it's in the stock market, riding this artificial wave created by endless money printing and corporate buybacks. Or perhaps it's in bonds, which are essentially guaranteed to lose purchasing power over time at current rates. Here's the uncomfortable truth that nobody wants to talk about. Your bank account isn't actually a safe place for your money. I know that sounds crazy. We've been conditioned our entire lives to believe that banks are safe, that FDIC insurance protects us, that the system works. But let me show you why that belief might be the most dangerous assumption you can make. First, let's talk about what a bank actually is. When you deposit money in a bank, you're not putting it in a vault where it sits waiting for you. You're making an unsecured loan to that bank. The bank takes your money and lends it out to other people. They keep a tiny fraction in reserve, usually around 10% or less. The rest? Gone. Lent out to borrowers who may or may not pay it back. Now, under normal circumstances, this system works fine. Most people don't need their money at the same time, so the bank can operate on this fractional reserve basis. But what happens when circumstances aren't normal? What happens when a lot of people want their money at once? We saw this play out recently with Silicon Valley Bank. One day it was operating normally, the next day there was a run on the bank, and within 48 hours, it collapsed. The 16th largest bank in America, gone in 2 days. And it wasn't alone. First Republic Bank, Signature Bank, Credit Suisse in Europe. These weren't small community banks. These were major financial institutions that people trusted with billions of dollars. And here's what should terrify you. The FDIC, the organization that's supposed to protect your deposits, has about $128 billion in its insurance fund. Sounds like a lot, right? Except there's over $18 trillion in deposits in the U.S. banking system. That means the FDIC has less than 1% of the money needed to cover all insured deposits. If we see a real banking crisis, not just 1 or 2 banks failing, but a systemic crisis, that insurance fund will be wiped out in hours. But the government will step in, you might say. They'll print more money to cover the deposits. And you're probably right, they will print more money. But here's the question you need to ask yourself. What will that money be worth? If the government has to print trillions of dollars to bail out the banking system, what happens to the purchasing power of every dollar you own? This is where gold becomes not just interesting, but essential. Because gold has a property that no other asset has. It's nobody else's liability. When you own physical gold, you're not depending on a bank to honor its promise. You're not depending on a government to maintain the value of its currency. You're not depending on a corporation to manage its business properly. You own a tangible asset that has been recognized as valuable for over 5,000 years of human history. Let me tell you a story that illustrates this perfectly. In 1971, President Nixon closed the gold window. Up until that point, foreign governments could exchange their dollars for gold at a fixed rate of $35 per ounce. But the U.S. had been printing so many dollars to fund the Vietnam War and domestic programs that foreign governments started demanding gold instead of holding dollars. So Nixon simply said, "No more. The dollar is no longer backed by gold." At that moment, gold was $35 an ounce. Within 9 years, by 1980, gold hit $850 an ounce. That's a 2,400% increase. But here's what's really important. It wasn't that gold became more valuable, it's that the dollar became less valuable. Gold simply maintained its purchasing power while the dollar collapsed. And we're seeing the exact same pattern today, just on a much larger scale. Since 1971, the dollar has lost over 98% of its purchasing power when measured against gold. Think about what that means. If your grandfather put $10,000 in a bank account in 1971, and somehow that account paid enough interest to keep up with official inflation, that money would have the purchasing power of maybe $200 in 1971 terms. But if he had bought gold instead, that same $10,000 would be worth over $600,000 today. Now I know what some of you are thinking. Gold doesn't pay interest. It just sits there. And you're right. Gold doesn't pay interest. But let me ask you this. Would you rather have an asset that pays 2% interest while losing 5% in purchasing power, or an asset that pays no interest but maintains its purchasing power and actually increases in value over time? Here's another way to think about it. Gold isn't an investment. It's insurance. It's a way to preserve wealth across time and across currency crises. Every major currency in history has eventually failed. The Roman denarius, the Spanish real, the French franc, the German mark, the list goes on and on. The average lifespan of a fiat currency is only 27 years. The US dollar has been a pure fiat currency since 1971. That's over 50 years. We're living on borrowed time. And the signs of stress are everywhere. The US national debt just crossed $36 trillion. That's trillion with a T. The interest payments on that debt now exceed the entire defense budget. We're spending more money just to service our debt than we spend on our military, and it's accelerating. We're adding $1 trillion to the debt every 100 days now. How does this end? There are only 3 ways to deal with debt of this magnitude. You can pay it back, which would require massive tax increases and spending cuts that would cause a depression. You can default on it, which would destroy the dollar's status as the world's reserve currency overnight. Or you can inflate it away, which means printing so much money that the debt becomes easier to pay back, but the currency becomes worthless. Guess which option they're going to choose? They're already choosing it. The Federal Reserve's balance sheet exploded from under $1 trillion before 2008 to over $9 trillion at its peak. They printed more money in 2 years than in the previous 200 years combined. And they're going to have to do it again. The next crisis is coming, and when it does, they'll print even more. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to where this is headed. Because here's where it gets really interesting. We're not just seeing central banks buy gold. We're seeing a fundamental shift in the global monetary system. For the past 80 years, the dollar has been the world's reserve currency. If you wanted to buy oil, you needed dollars. If you wanted to engage in international trade, you needed dollars. This created massive demand for dollars, which allowed the U.S. to print money without immediate consequences. But that system is breaking down. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several other countries, are actively working to create an alternative to the dollar-based system. They're settling trade in their own currencies. They're creating new payment systems that bypass the dollar, and they're backing these efforts with gold. China alone has been accumulating gold at a staggering pace. Official numbers show they've added hundreds of tons to their reserves, but many analysts believe the real number is much higher. China has been mining gold domestically and importing it from around the world, and very little of that gold ever leaves the country. They're building a gold reserve that could potentially back a new currency, or at least give them leverage in the coming monetary reset. Russia has been doing the same thing. After the sanctions imposed following the Ukraine situation, Russia accelerated its de-dollarization efforts. They've been selling dollars and buying gold, and they've been settling trade with China, India, and other countries in currencies other than the dollar. They're building a parallel financial system, and gold is at the center of it. Now you might think, so what? Let them have their own system. We'll keep using dollars. But here's the problem. If the world stops using dollars for international trade, all those dollars that are currently overseas will come flooding back to the United States. We're talking about trillions of dollars that will suddenly be looking for something to buy in the U.S. economy. That's the definition of hyperinflation. And it's not just a theory. We've seen this happen before. When the Spanish Empire brought massive amounts of gold and silver back from the New World, it caused devastating inflation in Spain. The currency lost so much value that Spain went from being the world's dominant power to an economic backwater. The same thing happened to Rome when they debased their currency. It happened to Weimar Germany. It happened to Zimbabwe. It happened to Venezuela. And it's going to happen to any country that prints money without restraint. The difference is, when it happens to the world's reserve currency, it doesn't just affect one country. It affects the entire global economy. And that's why gold is moving the way it is. Smart money, the people who understand how this game works, are getting out of paper assets and into hard assets. They're buying gold, silver, real estate, commodities, anything that can't be printed into existence by a central bank. Look at what's happening in the gold market right now. Investment demand has climbed to over 1,560 tons through just 3 quarters. That's a 33% increase. But here's what's really telling. This isn't just retail investors buying gold coins and bars. This is institutional money. Hedge funds, pension funds, sovereign wealth funds, they're all moving into gold. These are the people who manage billions of dollars, who have teams of analysts studying every market, every trend, every data point. And they're buying gold. Why? Because they can see what's coming. They can see the debt spiral. They can see the currency debasement. They can see the geopolitical tensions. They can see the banking system fragility. And they're positioning themselves accordingly. But here's the thing that most people don't understand about gold. The price you see quoted, whether it's $2,000 an ounce or $2,500 or $3,000, that's the paper price. That's the price of gold futures contracts, gold ETFs, gold certificates. It's not the price of physical gold. And there's a massive difference. The paper gold market is enormous. There are estimates that for every ounce of physical gold, there are 100 ounces or more of paper claims on that gold. It's the same fractional reserve system that banks use applied to gold. As long as everyone doesn't ask for physical delivery at the same time, the system works. But what happens when they do? We've already seen cracks in this system. During the pandemic, there were times when you couldn't buy physical gold at anywhere near the spot price. Premiums on gold coins and bars went through the roof. There were delays of weeks or months to get physical delivery. The paper price said one thing, but if you actually wanted to hold gold in your hand, you had to pay much more. And this disconnect is going to get worse. As more people wake up to what's happening, as more institutions try to convert their paper gold into physical gold, the system is going to break. There simply isn't enough physical gold to satisfy all the paper claims. When that happens, the price of physical gold is going to explode. Think about the mechanics of this for a second. The COMEX, the major exchange where gold futures are traded, has a tiny fraction of the gold needed to deliver on all the contracts. Most contracts are settled in cash, not physical delivery. But if even a small percentage of contract holders demand physical delivery, the exchange would be wiped out. They'd have to default or buy gold at any price to fulfill their obligations. This is why central banks are buying physical gold, not paper gold. They understand that when the system breaks, paper claims will be worthless. Only physical gold will matter, and they're making sure they have it before the crisis hits. Now, let's talk about what this means for you personally. If you have your life savings in a bank account, in bonds, in cash, you're holding the asset that every central bank in the world is trying to get rid of. You're on the wrong side of the trade. The institutions with the most information and the most resources are selling currency and buying gold. What does that tell you? But it's not just about protecting yourself from currency debasement. It's about having options when the system breaks down. History shows us that during financial crises, capital controls are often imposed. Governments restrict how much money you can withdraw from your bank. They limit international transfers. They freeze accounts. They impose wealth taxes. We've seen this happen in Cyprus, in Greece, in Argentina, in Lebanon. It can happen anywhere. But gold is different. Gold is portable. It's private. It's liquid. You can take it with you. You can trade it. You can use it to preserve your wealth across borders and across time. It's the ultimate form of financial freedom. And here's something else to consider. We're not just facing a currency crisis, we're facing a crisis of trust in institutions. People are losing faith in banks, in governments, in the financial system as a whole. When that trust breaks down completely, what will people turn to? They'll turn to the one asset that doesn't require trust: gold. Gold doesn't need a bank to honor its promise. It doesn't need a government to maintain its value. It doesn't need a corporation to manage it properly. It just is. It has intrinsic value that has been recognized across every culture, every civilization, every time period in human history. That's not going to change. Look at what happened in 2008. When Lehman Brothers collapsed and the financial system nearly imploded, what happened to gold? It went from around $800 an ounce to over $1,900 an ounce in just 3 years. It nearly tripled while stocks were crashing and banks were failing. The people who owned gold didn't just preserve their wealth, they increased it dramatically, and that was a relatively minor crisis compared to what's coming. In 2008, the problem was subprime mortgages and overleveraged banks. The solution was to print a few $1 trillion and bail out the banks. It worked, sort of. The system survived, but the cost was massive debt and inflation that we're still dealing with today. The next crisis is going to be different. It's not going to be about one sector or one type of asset. It's going to be about the currency itself. It's going to be about sovereign debt. It's going to be about the entire structure of the global financial system. And you can't solve that by printing more money. Printing more money is what caused the problem in the first place. When that crisis hits, and it will hit, the only assets that will maintain their value are hard assets: real estate, commodities, and especially gold and silver. Everything else, all the paper assets, all the digital entries in bank computers, all the promises and IOUs, they're going to be worth a fraction of what they're worth today. And here's the really scary part. Most people won't see it coming. They'll keep their money in the bank because that's what they've always done. They'll trust the system because they've been told to trust the system. They'll believe that the government will protect them, that the FDIC will cover their deposits, that everything will be fine. And then one day they'll wake up and find out that their life savings has been cut in half, or worse. But it doesn't have to be that way for you. You have the opportunity right now, while the system is still functioning, while you can still convert your paper wealth into hard assets, to protect yourself. You can do what the central banks are doing. You can do what the smart money is doing. You can get out of paper and into gold. Now, I'm not saying you should put everything into gold. That would be extreme. But having a significant portion of your wealth in physical gold, maybe 10, 20, 30%, depending on your situation, that's just prudent. That's insurance. That's making sure that no matter what happens to the banking system, no matter what happens to the currency, you have something of real value that can't be printed away or confiscated or devalued. And the time to do this is now, not later. Because once the crisis is obvious to everyone, it will be too late. The price of gold will have already skyrocketed. The premiums on physical gold will be astronomical. There might not even be physical gold available to buy. We saw this during the pandemic. We saw it in 2008. We see it every time there's a crisis. The people who wait until the crisis is obvious are the ones who pay the highest price or can't get gold at all. Think about it this way. Right now, gold is still relatively affordable. Yes, it's near all-time highs in dollar terms, but compared to where it's going, compared to what it will be worth when the dollar crisis fully unfolds, it's cheap. It's like buying insurance before the hurricane hits. Once the storm is here, you can't get insurance anymore. And this isn't speculation. This isn't a gamble. This is looking at the fundamentals, looking at what's actually happening in the world, and making a rational decision based on that information. The debt is unsustainable. The money printing is accelerating. The banking system is fragile. The geopolitical tensions are rising. Central banks are buying gold at record levels. These are facts, not opinions. The only question is, what are you going to do about it? Are you going to keep your wealth in a system that's clearly breaking down? Or are you going to take action to protect yourself and your family? Because here's the thing. Your bank doesn't care about you. The government doesn't care about you. The Federal Reserve doesn't care about you. They care about preserving the system even if that means sacrificing your purchasing power. They'll print whatever money they need to print to keep the system going, and they'll tell you it's for your own good. But the result is the same. Your savings get devalued. Your purchasing power gets destroyed. Your life's work gets inflated away. Gold is the way out. It's the way to preserve what you've worked for. It's the way to maintain your purchasing power across time. It's the way to have real wealth, not just paper promises. And it's the last safe place for your life savings because it's the one asset that exists outside the system. It's the one asset that can't be manipulated or printed or devalued by central banks and governments. So here's what I want you to do. Take a serious look at your financial situation. Look at where your money is. Look at how much of it is in paper assets that depend on the system continuing to function. And ask yourself, am I comfortable with that? Am I comfortable betting my entire financial future on the idea that the government will get its spending under control, that the Federal Reserve will manage inflation properly, that the banking system will remain stable? If the answer is no, if you have any doubt at all, then you need to take action. You need to move at least a portion of your wealth into physical gold, not paper gold, not gold ETFs, not gold mining stocks. Physical gold that you can hold in your hand or store in a secure vault, real gold that exists outside the banking system. Because when the crisis comes, and it will come, the people who prepared will be fine. They'll have preserved their wealth. They'll have options. They'll be able to weather the storm. But the people who didn't prepare, the people who kept all their wealth in the system, they're going to lose everything, and there won't be anything they can do about it. The choice is yours. You can keep trusting a system that's clearly failing, or you can take control of your financial future. You can keep your wealth in paper promises, or you can convert it into real, tangible value. You can wait and hope everything works out, or you can act now while you still can. The last safe place for your life savings isn't a bank. It's not a brokerage account. It's not a government bond. It's gold. Physical gold. The same asset that has preserved wealth for thousands of years. The same asset that central banks are buying as fast as they can. The same asset that will still have value long after the current monetary system has collapsed. Don't wait until it's too late. Don't be the person who looks back and wishes they had acted when they had the chance. The warning signs are everywhere. The smart money is already moving. The question is, will you move with them, or will you be left holding worthless paper when the system finally breaks?